started watching videos on business credit and how to raise business credit to use it to buy real estate and investments. And then all those events all together just led me to, I would say, buying 31 units within 18, 19 months, 21 through 22.
Nice.
And then before you know it, I had $200,000-$300,000 in business credit to play with that I was then going out and doing transactions with myself. You know, your paycheck, if you look at it differently, it's essentially looking at your paycheck as a license to print money. When you get a paycheck for $50,000, that means that you then can qualify for up to $500K in funding with banks if you structure it correctly and you start building those relationships with banks.
Welcome to the Doctors Investor Club podcast, where physicians and dentists come together to elevate their mindset, build their assets, and create a lasting legacy. I'm your host, Dr. Kyle Stevenson. After years in the OR, I've realized wealth is not just about high income. It's about ownership, freedom, and using your money with purpose. Here at the Doctors Investor Club, we share the strategies the wealthy already know: owning a business, real estate investing, becoming your own banker, and intentional investing. Each week, we sit down with entrepreneurs, investors, and physicians who stepped off the hamster wheel and are building wealth that outlives them. Because at the end of the day, it's not about how much you make, it's about how much you keep and the impact you leave behind. Let's get into today's episode. Welcome back to the Doctors Investor Club podcast. Today we have Dr. Benjamin Maciel, who is a medical director by training, who has also become a real estate broker and investor with a notable portfolio. He began his professional journey through the rigorous demands of medical school, earning his medical degree while simultaneously building a significant real estate portfolio with over 30 rental units. While practicing medicine, Dr. Maciel developed expertise in leveraging business credit to fund and scale real estate investments without using his personal funds, a strategy he now shares with other healthcare professionals interested in financial independence and passive income. Dr. Maciel, welcome to the show, sir.
I'm doing great. Thank you so much for having me.
Yes, sir. Absolutely. No, we appreciate you coming on. And we've been following each other on social media. I feel like I've gotten to know you a little bit just by watching your stuff. So I'm glad to have you on finally, and we can learn more about you.
Oh yeah, for sure. So I first saw you in I think it was on your Instagram when you were talking with apartment guy, Rob, when you were on his podcast, I think down in Florida, right?
That's right. Rod Cleef.
Yeah. So a little bit of background. I actually met Rob, I want to say 5-6 years ago. And this was back before even medical school, before I went to medical school, when he was syndicating apartments. And I was in the property management business at that time. And so I went down to go see him.
Okay. That's cool.
Yeah.
Well, yeah. So get into your history, get into your background of how you got into real estate. Sounds like you started with property management. Get into that, how you went to medical school, all that. Let's just go back to it.
Yeah. So I started out in property management just by happen chance. I started looking for jobs, right? Banging calls for jobs. I was more focused on marketing, and that was when social media advertising was just starting out. And I wanted to get into sales because, it's really scalable. Even at that time, I was looking for scalability, right? And so I ended up calling a property management company, and they needed an intern to help them out with their rental ads. And this property management company, they didn't even know how to advertise on Craigslist at that time. Right? They were still doing things like in the mail, on the newspapers, like ads like that. So when I went in and I started advertising and making ads on Craigslist, it was like, oh my gosh, this is, amazing. And so I started out there, as an intern, eventually got a job. And then eventually I got to buy out that business, myself and my partner, who kind of served like a mentor for a period of time. And so I owned that business for, I want to say, 4.5 years total. I was there, almost 5.
In your 20s?
Yeah, in my 20s. I was a baby. I mean, I was 22 years old roughly, and I had like 60-year-old employees. And so they ate me for lunch. They ate me for breakfast that first year, because you just don't know. You want to treat everybody like your aunt, your auntie, or your uncle, or like family, and I'm very family oriented, right? And so you got to learn the hard way how it is in business. As soon as I bought the business, half of my staff quit or got fired, or there was some kinds of issue. By the time I left there, I think there was only 2 employees from the original group. Everybody else had to get replaced because they just weren't into change or changing accounting systems.
Mm-hmm.
So went through two or three, I think, lawsuits at that time, right? So I got thrown into the fire, like legit thrown into the
Mm-hmm.
fire. But it just really made me stronger. And so by the end of me being in the Midwest and owning that property management business, that's when I decided to figure out what I wanted to do next because I was 27, 28 years old at that time. And I was like, this is really my only shot to try and change the trajectory for me. Because I don't want to live in the Midwest, away from family, very far away from family in a town of only, I think, 40,000, right? 30 minutes north of KC, but there was only 40,000 people there. And the real estate market was like, buy a $20,000 property, put 10 into it, fix it up and rent it out for the next 20 years and then buy a
Mm-hmm.
trailer park in Florida and retire. Like that was the common theme for a lot of the investors in that specific area,
Okay.
right? And so to me that was like, "Oh my gosh, this is me in 30 years from now. I'm going to be this
Mm-hmm.
guy, still coming back here but living in Florida in a manufactured home. And I was like, I can't do that. I got to do something different. And so it was just one thing after another that made me and led me into medicine. The other thing was I'm very like a spiritual person. And at that time I was becoming a lot more religious, right? And so seeing my baby's mom at that time working in nursing and working in healthcare, I always looked at it like, wow, you're helping people. You're serving people.
Mm-hmm.
And so I went and I shadowed one of the anesthesiologists there. And then within the day, 2 days of shadowing total, but within that first day, I was like, wow, I want to do this. Watching a cardiothoracic anesthesiologist behind the curtain
Mm-hmm.
was awesome. And then peeking over the curtain and seeing an open chest, and you're like, oh
Oh
my
yeah.
gosh, it was one of those things that it kind of hit all the boxes. It really checked all the boxes. And so by the time I wrapped up my business, I referenced Chris, but Chris was one of the people that helped me really grow my business to the point where it was even sellable. A lot of businesses, they're just not sellable, right?
Mm-hmm.
Because they're not profitable. They're not built to be a business. And
Yep.
so I had to get a lot of information. I had to get a lot of wisdom in a short period of time to actually make the move and the pivot to medicine. And so from there, really, it was all about how can I get to medical school the fastest, you know? And when I found out that I would have to do 2 or 3 years of a post back and all this kinds of stuff, my heart was broken, right? Because I was like, man, I gotta go back and do a post back. I gotta
Yep.
rack up 50, $60,000 worth of student loan debt plus not work, right? And I just remember being down and hurt because I was like, man, I want to have kids as soon as possible. I don't want to wait anymore, because at that time I was already 26, 27 years old. And so by happen chance, somehow on YouTube, I saw a video of a girl in the Caribbean going to the Caribbean medical school, right? And made two or three calls, chatted with her. And before I know it, like 6 months later, from the time that I sold my business to the time for 6 months, I was in the Caribbean, like that quickly,
That's
you
great.
know? Yeah. And so went through that. And then COVID happened, right? And when COVID happened, it was like the biggest blessing in the world because I was sitting there in an apartment with some real estate experience, but not a whole lot. We could talk about that.
Mm-hmm.
And then I started watching videos on business credit and how to raise business credit to use it to buy real estate and investments. And then all those events all together just led me to, I would say, buying 31 units within 18, 19 months, 21 through 22.
Nice.
Yeah.
Good for you. Well, so that's cool. Before you went to medical school, you already had a ton of experience. You
Yeah.
learned business the hard way, which most physicians never learn anything about business or finances. So you already understood that before you went to medical school, which gave you a huge
Yeah.
leg up, whether you knew it or not.
Yeah.
That's great. So yeah, we'll get into more of the real estate aspect. But so you went to medical school. Did you graduate, move on, and practice, or what happened there?
No, so it was really a combination of things. I mean, just to match and to get into residency as an IMG, the timelines are so like drastically changed. I have a YouTube channel, Benjamin Maciel underscore MD, where I talk about this in one of the videos. But essentially, because I enrolled in like a May semester in the Caribbean, right? But you can only match one time a year.
Mm.
And so my graduation date was one semester late from matching in 2024. So then that gave me, I want to say, 9 months of not doing anything until match time. And before you know it, you got two, three kids, you got all these alternative options in real estate,
Mm-hmm.
right? How I can't justify going to residency working 60, 70 hours a week when I can make 150,000 in a refinance.
Yeah.
Or I can pull out money, or I can work in a business that's scalable, especially with young kids.
Mm-hmm.
When you got like a 1 year old, a 3 year old, and a 4 year old, it's like, that part's kind of hard. That part's the hard part. I'm not
Mm-hmm.
ruling out that I may apply to residency in the future, but right now while my kids are really young, it's kind of like I could do other things,
Yep.
you
No, I
know?
mean, it's a good point you bring up. So, with the Doctors Investor Club, we've partnered with the Family Office Club, and you get to hear about what the wealthy are really doing. And to your point, like scaling a business is what the wealthy do.
Yeah.
Um, and then not trading your time for money, which is what doctors do, but the
Yeah.
wealthy don't, right? They try to find systems where they don't have to trade that time for money.
Yeah. I just recorded a reel right now, and it basically says that doctors are some of the most underpaid people when you factor in time being the biggest asset we have.
Mm-hmm.
When I really think about it, even me personally as an IMG, I feel like I was able to get away with 2 or 3 years. But if you really factor in 4 years of undergrad plus 1 or 2 gap years, right, for research or building out
Mm-hmm.
your resume, right, scribing, so many students do scribing in that time period,
Yep.
plus 4 years of medical school, plus 4 to 7 years of residency training, you factor in all that math, plus the opportunity cost, plus the student
Mm-hmm.
loan debt, you're like, wow, they're actually not paid that much,
Yep.
relative to the time that it takes. There's a lot of catching up to do, right? And
Mm-hmm.
so, yeah, absolutely. And then the hardest part and the biggest adjustment for me was when I got into medical school and I couldn't hire an employee to do my studying for me. It
Yep.
was so rare for me having a problem in my life that I couldn't pick up the phone and call up a mentor, or pick up a phone or post an ad for somebody to do that job that I was having trouble with.
Mm-hmm.
And in my experience now, this last 18 months since doing Instagram and consulting, I don't do coaching, I do consulting, and we can
Okay.
kind of talk about that.
Yep.
But in talking with a lot of MDs and nurses specifically, they want to do everything themselves versus be able to pick up the phone or sub
Yep.
things out specifically. It's kind of like
Yep.
an opposite, like I was trained, you get into something, you learn it, then you give it to somebody else and you train somebody else to do it while you move on to bigger things, making
Mm-hmm.
offers on deals, scoping out projects, marketing, right? And that's really the shift in mindset that I had to have coming into medical school. Is like, oh my gosh, it's just me in an apartment by myself for 14 hours a day studying, you know?
Yep. Yeah, no, that's so. I mean, you bring up some good points there. And again, doctors don't learn any of this stuff, right? And so you start reading these
Yeah.
books. Dan Sullivan, Who Not How, right? Finding the right who's who can help you leverage, right? You
Yeah.
use somebody else to help you leverage your time. And then the other thing I just thought about, and I just lost the author for some reason, but buy back your time. Dan
Hmm.
Martell, buy back your time, right? It's like you can
Hmm.
offload things to a virtual assistant or an employee to buy back your time. You can focus on your highest and best use
Oh
to
yeah.
make the most money for your business or yourself.
Oh yeah, yeah. I've realized honestly, like when it comes to making content, for example, I can't stand making content. It's so hard sometimes, and it comes so unnatural to me. I understand I
Mhm.
gotta do it, because I'm gonna be on social media anyway. So you might as well start a consulting business or something like that.
Yep.
But I love, love, love pulling up a list, cold calling, building a business, that part, kind of the nuts and bolts. I really
Hmm.
enjoy that part. But like what you said in terms of hiring VAs and consultants, etc., it's I mean, you just got to be able to do it. You got to be able to release those breaks, which talking about books, James Newman, Release Your Breaks. That was a book that really just changed the world for me
Hmm.
because it allowed me to recognize, like, okay, this is something I'm having a real problem with, that I need help with, that I need advice, that I need to hire somebody for, if that makes sense, and
Hmm.
outsourcing. Whereas what I do best, which is just pick up the phone, call, find motivated sellers and try and close deals.
Yeah, no, that's great. Well, let's talk about that real estate. So obviously you had the property management group or business, you sold it,
Yeah.
went to medical school, and then you had a long term to wait and or a long time to wait. And obviously you went to medical school, it sounds like during COVID, which was very difficult for
Yeah.
all of us. So then, yeah, how the real estate investing start from there?
Yeah. So at that time, I was in medical school, I was in an apartment. It was pretty much extremely lonely, right? It was everything that I didn't think medical school would be. I thought medical school would be like Grey's Anatomy. I thought it would be at least like nursing school where you're doing rounds and you're on a college campus, with other people, not on Zoom or Skype listening to somebody. I don't know. I mean, I don't want to downgrade or downplay the education during that time, but at the same time, I feel like there was a lot of left on the table
Mm-hmm.
in terms of the educational experience. And so I was just sitting there, 8, 9 hours a day and scrolling on YouTube and real estate, business credit, started seeing a bunch of videos on it, right? And the thing and the issue with me living in the Midwest was that, yes, I owned a property management company and I was watching transactions and I got to sit at closing tables with a lot of deals, but I didn't have any access to capital. I
Mm-hmm.
didn't have any access to capital. And my experience with the partnership, which we can talk about, was extremely rough because you got somebody putting in money as little as 50,000 or 100,000, but then they're taking 30, 40, 50% of the equity, which a lot of people don't talk about. And so I didn't want partnerships because I didn't want to give up that equity.
Mm-hmm.
But at the same time, I didn't have any of my own money to put together deals. And so that's when business credit just at the right time, at the absolute right time, came and saved the day. And that's what allowed me to just start making moves in real estate, starting out with single family homes, duplexes, fourplexes. And during that time, though, interest rates were going down like dramatically.
Mm-hmm.
I remember buying a property at like 3.8% interest and being upset like 4 or 5 months later because interest rates had gone down to like 2.5.
Yeah. Yep.
you
So this
know
was around like 2021, 2022, right?
yeah, for sure, for sure. And so it all started again with just applying for my first business credit card, asking a lot of short, in-depth, in detail questions from banks and doing a lot of research on YouTube. And then before you know it, I had $200,000-300,000 in business credit to play with
Mm.
that I was then going out and doing transactions with myself.
Okay. Well, okay. So let me just stop you there for a second. So, we talk about OPM, right? Other people's money. A
Yeah.
lot of people are like, okay, that'd be nice to use other people's money. How do you do that? There's a couple of ways, like for me, leveraging like a cash value whole life insurance where you're
Hmm.
borrowing against it, or an asset line of credit, right? Where you have your stocks portfolio and you can borrow against that and you can buy real
Yeah.
estate. Um, and then my last episode, I just had a guy by the name of Jerry Vaughn on, who works at or is the CEO of Guardian Chamber, but he talks a lot about business credit, and it's really the first time that I learned much about it.
Hmm.
And so, explain to me. I mean, he was kind of saying like you got to have your business and you build credit intentionally, and then it gets
Yeah.
to a point to where you can now use that money, borrow against it, buy equipment for your business, or buy real estate, whatever you want to do.
Yeah.
So, just explain to me how it works and how you were able to do it as an individual.
Yeah, so real life practical application, I think specifically, and this kind of goes in line with my consulting business, right? What I do in my consulting business, it's not coaching, it's consulting. I get people in, we create a funding LLC, and I introduce you to my business relationship managers that I've raised business credit with directly. And what they do is they take your credit, take whatever specialty you're in, right? Your existing credit, existing specialty, and then they tell you what you qualify for business credit wise. So within 3 to 6 months, if you're an actual practicing MD, you have a practice or at least even a W-2 job.
Mm-hmm.
From there, you can build out 3 to 500K in business credit that then you can start utilizing for investing in real estate or buying a practice, etc. And so
Mm-hmm.
that's the consulting side of my business. I do that because I don't like asking people for their own personal money. And the reason for that is because if for whatever reason, just like you're aware, real estate markets change, etc., it's a
Mm-hmm.
lot easier to tell a bank, hey, we're struggling right now because of the market, because of this. Here's the situation. This is why we need to readjust the interest rates, or this is why we need to ask for a forbearance or something like that, versus telling a guy that just put $300,000 of his savings or IRA into a deal that, hey, we can't issue out, distributions this month. And so it's along the lines of OPM, but it's building and raising up partners' business credit themselves. So that way, then we can partner and do deals with credit and focusing on their credit first versus their 401ks, etc. Now, the idea that a lot of people have $500,000 to $700,000 in an IRA or whole life insurance and somebody under 40 is very rare. A lot of people under 40 don't have a whole lot of money like that sitting in an IRA or a whole life insurance, is my understanding based on the data that I've seen. And so realistically, pitching a 30 to 40-year-old on real estate using their 401k and IRA, it's just not, it's not probably very efficient for me. So all I talk about is basically telling people exactly what I did. I took a $30,000 credit card, I manufactured spent on it. I got it up to 30K. I did that across 4 banks. Before you know it, I had 140, 130K to play with business credit wise. That was enough for a down payment on a fix and flip or a fix and burr project, fix and rent project. And you just repeat the process, But raising business credit mostly has to do with structuring your income. So most people, what they do is, let's say you make 50K a month, you get the 50K a month, you pay all your bills, pay all your expenses, and then you pay yourself a salary, right? Assuming you're a 1099 MD. And then from there, you take whatever you have left over, put in a specific account, and you'll say, this is what I'm going to save up for a down payment on real estate with, right? Whereas with business credit, the way we structure it is you may get 50K on a Friday morning, and then that Friday, we're going to go to the bank and get a secured loan, right? For 50K. You put up 50K, but then you walk out with $49,950, right? And you do that across 4 or 5 banks. And before you know it, I mean, you got 500K in business credit with utilizing nothing but the bank's money. And so it's just structuring your income a specific way to build credit. That's it.
Yeah. So you're talking about collateral. Like you go in there and say, here's my collateral, which is basically your income.
Yeah.
Okay.
Yeah. It's basically your paycheck,
Yep.
Your paycheck. If you look at it differently, I made a video on this, but it's essentially looking at your paycheck as a license to print money. When you get a paycheck for $50,000, that means that you then can qualify for up to 500K in funding with banks if you structure it correctly and you start building those relationships with banks. And so let's say you start off with secured loans, you make positive payments over 3 months, and then you take that 50K back, you pay off your secured loan. Well, now you have business credit with that specific lending institution at a massive amount, And you're going to start getting offers and communications and contacts. But by hiring me and working with me, now you have direct contacts with business relationship managers that I've worked with. So you can kind of skip a lot of those steps that I had to first go through when you go to banks. When I went into bank the first time, I had to go there, talk to the bank teller. I had to go there and talk with a local manager, right? Before you know it, 6-7 months goes by and you're still only walking around with a $10,000 credit limit, Whereas as an MD, if you structure it correctly, you can go straight to the business relationship manager and get access to all this funding, And so that's pretty much all it is just raising up people and their business credit to get them on the game board to start investing in real estate and doing projects. Now with partners specifically, I like to do like fix and flips. I don't like to do no long-term hold deals because, as you know, long-term holds with partners more than 2 years is kind of tough. It's kind of tough. There's a lot that can go wrong.
Yeah, no question. Okay. And then, so real quick, before we get into what you guys are actually investing in, can W-2 employees, like 75% of docs now are W-2 or, employed by somebody. Could they build their credit as well? They have to get like an LLC to do it?
Yeah. Yeah. So it's the same process for a W-2 employee as it would be for a 1099 employee. You still got to create your own LLC. We still got to introduce you to business relationship managers. We still got to do that structured, structure income sources to effectively build credit. The biggest thing I think that the audience could take away from this is you essentially want to start off with a bigger amount. So if you're trying to raise business credit with just whatever money you can put to the side each month, you have to think opposite. You have to first start off with, hey, I need to structure my income to build credit first and then pay my bills. It's completely different change in cash flow in your personal finances, if that makes sense. You just have to change it around. That's it.
Yeah. Pay yourself first, basically.
I love that. I'm gonna steal that. Pay yourself. That's actually perfect when you think about it.
So okay, so all right, and are most of your consulting clients physicians? Would you say?
Yeah. So the 8 active ones now that I have, they're physicians, but I also got like a lot of family and friends.
Okay.
Because the thing about this is that it's not a specific thing exclusively for MDs or healthcare providers. I just like to target them because they're my target audience. Plus, there's other connections in business that we can do. So that's why it's my specific audience. But yeah, the concepts and the principles surrounding business credit and finance is the same across industries.
Yeah. Okay. That's good to know. So you talked about fix and flips. So what kind of deals do you like? Where are you investing mostly? Where do you live? Are you investing in the backyard, or what are you doing?
100% my backyard. What I learned about property management is that when you're in the Midwest, yes, you get the cash flow, but if you're not actively there, living there, like you're in Indiana, you live there, and you get to knock on doors and do those kinds of deals, the opportunity cost, the risk versus reward sometimes just doesn't make sense for a lot of, I would say, small scale residential stuff. Now, once you get into like a 300 or 400 unit apartment building, I understand you can hire property managers and things like that, but then your return on investment isn't as high oftentimes. I think the cap rates are a lot lower, right? And so me specifically, it just made sense for me to invest locally where I'm at. But this is a big thing too. My personality, I'm a hands-on person. I love being on hand, having hands-on, going walking the jobs on Fridays with my kids, right? Whereas with a lot of people that they truly love medicine, they're working 40, 50, 60 hours a week. I would much rather give my money to Kyle and let him invest it for me, check in with him every 2 to 3 months or whatever that looks like, right? So it's just a different kind of personality for me specifically. So I like to invest local because I like to go out there with the contractors and shoot the shit with the normal people. I call them the normal people. And so for me, it's just my style. I like to be more active.
Yeah, which is great though. I mean, you hear too many horror stories about people getting taken advantage of by a contractor, right?
Yeah.
If they're, from California investing in the Midwest, that can happen. Especially the people that give their upfront money to a contractor and then they just jet middle of the project. So good for you for having you're always keeping your eyes on it.
Well, here's another reason why you do business credit too, right? Is if you give out your own money, once you give it to the contractor, that's gone.
Yeah.
But once you use business credit, you pay a contractor with like a credit card, you can dispute the charge. There's all kinds of, I can go probably go over 1,000 ways why using business credit is better than cash, but that's one right there. You pay a contractor, you give him a deposit, and then before you know it, he opens up the job, tears it apart, and then he disappears for 6 weeks.
Right.
So that's all notorious. So it does make sense, I think, in the grand scheme of things, for 90% of people wanting to get into real estate to invest passively with people like you, for sure. And about 10% who are crazy, it makes sense to try and do your own thing locally.
Yeah. Well, if you can partner with somebody like yourself who's doing it, who's boots on the ground, that goes a long way.
Yeah.
So, to them, it's going to be passive, right?
Yeah, definitely.
Yep. All right. Well, how about this? So, there is such thing as a deal gone bad. So what happens if you invest that business credit into a deal? You could be over leveraged, if you will.
Yeah.
Deal doesn't go as well. How are you paying that credit down? What's going on with there?
Yeah. So I like to always preface this by saying that banks love to lend money. That's why they market and set up commercials.
Mm-hmm.
You know, when I first got into actually walking into banks, it was myself and my 7-year-old partner who had bought and sold 23 businesses. So he already knew the game. He
Yep.
already been through all these recessions. So I was just sitting there, riding his coattail into a lot of these bankers meetings, trying to buy a local business. And he taught me one thing that I'll never forget. But basically, it's setting your expectations with banks and lenders and always paying the little guys. You always pay the little guys because they're not in the business of collecting money. They're in the business of providing services. So when deals go bad and deals go wrong, you always make sure to pay your contractors, the people that actually helped you put the project together, you know? And then you start worrying about the banks. And banks have collections departments. They're big boys. They're
Mm-hmm.
used to lending money, maybe missing some payments, having to restructure and renegotiate deals. People who invest their own money into properties, they're not used to going through the process of collecting money. So that's a whole nother layer of why I love partners who utilize their business credit first, because then they're not using their own money to invest in our project. So when things go wrong, all it is a call and a communication with the bank, telling them the scenario, telling them the situation, and trying to make things work positive as possible. But it's a lot easier for me and for a lot of people, probably honestly, to call up a bank and say, hey, the project's not working because of this, this, and that, versus calling up a friend or a family member who invested hundreds of thousands of dollars in your deal and it not working out.
Mm-hmm.
you know
Yep.
so practical example is, hey, we get this 16 unit apartment building actually that I'm looking at. You get a 16 unit apartment building, we're putting up almost 650,000 in business credit lines and about 150,000 in cash, right? And ideally, what ends up happening is we're able to buy it, fix it up, resurface the parking lot, redo all the siding, put in a new roof, right? Evict all the existing tenants, put half in there, Section 8, do something really, really that's a good solid job. Get it refinanced or sold, right?
Mm-hmm.
But what happens if that refinance, or what happens if that closing comes in, 10% short or 15% short? Well, then all it is just a matter of renegotiating your debt. So you have,
Mm-hmm.
let's say, a business credit line at 18% after 12 months. Well, then you would call them up and try and work out a longer term debt payoff scenario, maybe like a 10-year payoff or something like that. Versus telling your friend, hey man, you're going to be out 400,000 bucks,
Mm-hmm.
you know?
Yeah, no, that's good.
So
Now, and are the banks doing their own due diligence on the underwriting?
yeah. Well, yeah, it's like any other loan, right? They have their loan department, they have their
Yep.
lending department, they have their own underwriters, et cetera, that are going to be there to actually approve you for these kinds of credit lines.
Mm-hmm.
Now, the thing about mortgages and hard money and private money, you also have to spend a chunk of your time, shopping debt.
Sure.
I call them funding Fridays, but on Friday mornings throughout the week, I'll be driving and I'll see this new offer for a bank locally. Or I'll be on Instagram and the business credit line, the ads just are like crazy.
Mm-hmm.
They're like crazy. And so on Friday mornings, I like to just call up these lenders, look at what their terms are, look what their requirements are. And for a lot of people in healthcare with 700 credit scores, I mean, the access to funding is just unreal.
Yeah.
It's really unreal. For a person that wants to start investing locally in their area, let's say they live in Indianapolis, Indiana, you can probably get an Aplex for like 500K, right?
Yep.
And people are still making 80 to $100,000 out there as nurses and MDs, what, 400,000 at least, right?
Yeah.
Yeah, so you can get a business line of credit for the down payment in a relatively short period of time, and
Mm-hmm.
before you know it, you get the right team around you. I mean, you can stack up units like crazy.
Yeah. No, that's cool, man. I like that because access to capital, to your point, is a big deal. And I know a lot
Yeah,
of physicians who, to your point, like make really good money and still don't have access to capital. Their
it's
money's tied
crazy.
up in a 401k, IRA.
Yeah,
They can't touch it till they're 59 and a half. And they're like, well, I don't have any money to invest in real estate. I want to
yeah,
invest in that deal, but I don't have the money. It's like, well, now there's more ways to access that
yeah.
capital.
Well, yeah, you would tell them, hey, Benjamin has this consulting group, we're going to put you through the process of raising a bunch of money. And this is what I always tell people because as soon as they hear credit, they go to credit cards. They
Yep.
go back to when they're 7 years old and they
Yep.
think about their mom who couldn't pay the credit card bill and she was sitting there in the kitchen crying. It's different when it comes to business credit. All you're trying to effectively do is increase your
Mhm.
purchasing power of assets, things that actually produce money. You know, what I don't do though is I don't tell my friends, hey, you know what, we're going to start up this new coffee shop with this business credit. We're not going to do that. What we're going to do is we're going to try and buy another practice competitor of yours, or we're going to go out and we're going to try and buy some investment properties. Those are the only two things that I like doing: medicine and real estate. Medicine
Mhm.
and real estate. So there are some people that they have hobby businesses that they want to start on the side that have nothing to do with medicine.
Right.
And I'm like, you might want to use your personal savings for that. You don't want to use business credit for that.
Yeah. Yeah. Taking that big
You
risk.
know? Yeah.
Yeah, that's good, man. And what about syndications? Could somebody use their business credit to basically put $100,000 into a 300 unit syndication?
So let me tell you about a call that I got recently. So I got a
Hmm.
call from this guy in Tallahassee, Florida. Somehow or another, he found me on Instagram and YouTube, and so he started talking to me. Probably took him about 25 minutes to finally get into the nuts and bolts of the conversation. And I'm a pretty cool guy. I love to talk business. I love to talk shop. And it just happened I was driving, right? And so I'm listening and I'm listening and I'm listening. And I said, okay, you're trying to set up a syndication? And he says, well, no, it's not a syndication. I said, yeah, well, that's what it sounds like. You're pulling together our money and you're going to go buy, a land development deal for a subdivision.
Hmm.
Now, I like the idea of syndications, but it all depends on your knowledge base, your skills, but also your emotional tolerance level. Like my emotional tolerance level when I was 21, 22 years old, owning a property management business was like down here. And a lot of people's emotional intelligence level and tolerance level, because they've never worked, like when you become an MD at 33, 35 years old, you've never been in business before.
Right.
So it's just different. So you don't like that emotional tolerance isn't there. So
Hmm.
I think for people that are just starting out, man, go out and put your money into a trusted syndication that you really agree with, but make sure you vet them because
Yep.
this person was raised in money and he wasn't even licensed as a syndicator.
Yeah.
He's just putting together stuff. He found me on online, and
Hmm.
I think his deal was going bad, and so he was just making last minute calls to try and raise
Hmm.
money to save his deal. But make sure that you put your money into somewhere smart, safe, into somebody that's maybe 40, 50, 60 years old that is really seeing a lot of things,
Yep.
you know, and learn from them. Don't just sit there and throw your money out and never talk to them. Like sit there, ask questions, ask for ideas, ask for tips, ask for strategy, try and learn. And so that's what I would say. I would say probably first off, you know, do a syndication, throw your money, put some money in there. But when it comes to specifically using business credit for the syndication, it just depends on how much control over the project you have.
Hmm.
Is
Yeah.
it a 5 year project? Is it a 5 year project? Is it a 3 year?
Yep.
All that stuff matters.
Yep. No, I think it's great advice. I mean, you're talking about doing your due diligence on the operators on the team, knowing their track record, knowing their, the ins and outs of their business.
Yeah.
Um, because there are a ton of operators out there who, yeah, to your point, have only been doing it for a few years. And it's
Yeah.
like the market cycles, are up and down. And right now it's not a great market cycle. And there's been a lot of failures over these last 5 years,
Yeah.
right? It was
Yeah. And the
like,
markets change, and the
yep.
markets change too. I had this guy, I kid you not, and I never forget him. I won't say his full name, but I'll say his name is John. He came from Southern Florida and he was a techie, right? So he came from Southern Florida. He was a techie. A lot of guys. I mean, you would think that this guy was like the main star in a sitcom. Like every other day, I would get a call like, "Hey, I'm with John." "Hey, I'm with John. Hey, I'm with John." Well, he went out with his friends and he raised a bunch of money from these internet guys, right, in Manhattan Beach in South Florida, and they came out and bought a bunch of properties in the town where I was at. But in the town where I'm at, Like we're talking rundown buildings, deteriorating areas. St. Joseph, Missouri, for those of you guys that are listening. And so a lot of the buildings that he was buying, simply because of the population to building, there was just no demand for those buildings, even if they're fixed up. And it was just like a disaster for them. And I just remember him just coming in maybe every 3 months or every 6 months, changing management companies. So he fired us, he hired another group, he fired another company, tried to rehire us. And you're not vetting the deal, but also you're not starting off with vetting the operator. If the operator's not living specifically where those properties are, I would say definitely that's a cause of concern. What do you mean? You're not living in this specific area where we're trying to buy property. I'm not saying that it's impossible, but what I'm saying is like there's certain ways and certain steps that you can follow that eliminate the risk. And having an operator that's not actually in the market where you're actually raising the money for as a syndicator, it's a lot more risky, if that makes sense.
Yep.
So if I was, let's say I was a 35-year-old doc and I'm just starting out investing in real estate. I finally got my legs underneath me after residency. Now I have 500K. I would tell them, yes, partner with a syndicator or put your money into a syndication no more than probably 2 years with an operator who's actually living near the project. That would probably be sound advice. I think everybody would agree with that.
Yep, that's great advice. Location, location, location is the first thing, right? And then an operator, to your point, who knows what they're doing in the right location. I mean, that's everything. Now, let me just kind of, we're going to continue talking about real estate. I love it. Let's talk about the physician mindset.
Real
go
quick,
ahead.
Though,
yeah, please.
Even that's a risk, though.
Definitely.
Because the interest rates can change.
Yep.
So just so people don't end up blaming a syndicator on a deal that goes bad, nobody could have predicted that interest rates would swap like that. And so if you expect to just put your money with somebody and it's safe no matter what, well, you're going to be sorely mistaken. So, put your money out there, do that kind of thing, but at the same time, expect to do 10 to 15 deals realistically with somebody before you write them off. I'm going to put, let's say I put 500K with Kyle in 21, that we did a deal and then the market didn't do the proper return on investment. Well, it's not Kyle's fault. Look at, he's done 20 deals, and out of those 20 deals, one of them went bad, or one of them didn't return the investment right away. So it's a volume business as well.
Yeah. I mean, okay. So to that point, I talk to physicians all the time who are like, well, why don't I just keep my money in the stock market, index funds for 30 years and then retire and take my money? Like, why would I take that risk into real estate as opposed to the stock market? So what do you say to that, I guess?
If a guy has a certain appetite for mediocrity, I would tell him, put your money in the stock market, and in 30 years, when you're probably too old to crouch into a Corvette, maybe you might get there. You never know, But I'm an adventure guy. I'm here in life for the experience. I'm not here for safety and security. So I would say, yeah, you can do that, but when you're 60, 70, 80 years old and you're like, dang, you're driving past one of my apartment buildings and you're like, shit, I could have invested in that thing. I was a physician. I had access to all the money in the world. I had all the credibility in the world to walk into a bank and raise $1 million, $2 million bucks. But I decided to kind of sit and just throw some money in the stock market. Now, 401ks and IRAs, I just started doing some research on them. Like, they don't always, the return compared to inflation doesn't always make sense. Doesn't always make sense.
Yeah. And there's fees with those that we don't even know about, right? The government has control of those. There's fees. And nobody really talks about it. But if you listen to like Tony Robbins and some wealthy folks, they do talk about it. You can read about it. And then
if Tony Robbins, like, and all these guys, then why does he own all these businesses and companies?
Right.
He never starts off with, I own stock, I'm investing in stock. He always starts off with, my businesses do $4 billion in sales a year. There's a reason why. Real estate is a business.
Yep. That's a good point. Garrett Gunderson, I'm not sure if you know who he is, but he wrote the book, What Would the Rockefellers Do? And a couple others. He just had something out there where he's, Charles Schwab and Vanguard and all these guys, they tell you, diversify into index funds and, grow your wealth and retire and have all this money. He's like, that's not what they did. They
Nope.
created the business of convincing you to put money in index funds because it puts more money in their pocket, but they own the business. They're not
Yeah.
diversifying their money into index funds.
Yeah. Oh yeah, 100%. And I'm telling you, from just being a property manager, I watched what successful people did. I watched money flow. Like, oh, hey, here's 10 new keys. How the heck did he buy 10 new keys? Well, he
Mm-hmm.
sold an investment property in Texas, and with the proceeds from that, he came out and bought all of these doors. And you see the cash flow. You're writing off the distribution checks.
Mm-hmm.
You're seeing an accountant call you asking about segregation reports,
There you go.
right? And really, if you look at the stock market, you're selling stuff retail price to people oftentimes. So you're
Mm-hmm.
selling it at market value with little upside other than a hope and a dream. Somebody gets a cold or a flu, and then all of a sudden Bitcoin's down to 60,000, right? And so I don't know. It's just I'm at the point now where I stopped trying to educate people
Yep.
and more about showing people, if that makes sense.
Yep. Yep. No, that's
Uh,
good. There's tax benefits to real estate that there's not with stocks. There's leverage.
oh
There's,
yeah, for sure.
yep.
For sure. And when you go to a bank and you walk out with a 50K credit limit, you just effectively created $50,000.
Mm-hmm.
And you're like, "Oh my gosh, why am I gonna save cash for investments when I could just use this?" Or why did the whole financial system start running on fiat currency?
Mm-hmm.
And you start finding out that, like what you were saying, all these business guys that are selling stocks, they're the ones that are effectively using printed money to buy gold mines and silver
Yep.
mines and military equipment and stuff that, real assets, right? That produce cash
Yep.
flow. And so all it is just in a smaller form, just raising paper money and buying apartments or buying real estate with it. But what I really like the most is buying out competitors,
Mm-hmm.
buying other practices. If you're a surgeon, buying another surgery center. You can pick up a lot of surgery centers right now for effectively pretty cheap, especially with a lot of SBA funding.
Mm.
So
Yeah, I
that's a
believe
whole
that.
nother avenue in the conversation.
That's great. No, I love it. And if people really understood what banks do, right? When you put your money in the bank, there's a thing called fractional reserve where they can take basically 10x that money and borrow, lend it out, and then they make
Yeah.
money on your money, and it's basically just printed money, right? It's that fiat currency you're talking about.
Oh yeah, for sure. And just the only inflation that anyone can think of is just going to the bank and printing money, printing your own money. Like I created this book, right? Credit for Assets, Creating Money, not to plug here, but it's
Plug.
literally you creating money. It's
It's
on
awesome.
Amazon. It's you creating money. I'd outline exactly the processes that I went about creating the down payment money that I needed for real estate and stuff to get started. I could never imagine a world where I try to save money for down payments or imagine trying to save money to buy an apartment building that's worth changing your life. It's really
Mm-hmm.
hard to find a way to save $100,000 that can pay you $10,000 a month for the rest of your
Right.
life. You can't do it.
Yep.
It's really hard to do that.
That's great. No, this is good. Finishing up here, give us some for the physicians listening to this, give
Yeah.
them some advice on what you would say to them. Is it educate yourself better? Is it, what
Mhm.
is it? What would you advise them to do? What's the next step, or just
Yeah.
any mindset shift?
I would just say, honestly, in my experience, these last 18 months working with a lot of MDs and physicians, they think they're like special. They think that because they're MDs and physicians, that they're going to just have access to all of this investment opportunity, right? And because they got the credibility, that for some reason it's going to just connect for them financially. And it's actually the opposite. Because you're an MD, because you're a physician, because you're so busy 60, 70 hours a week with some of these contracts that people are signing, you're not going to have a lot of access to a lot of these opportunities. And so you actually have to go out there and actively learn and network and get around people that are multiplying money,
Mm-hmm.
if that makes sense. You get around people like Kyle who are multiplying money, they're taking $500,000, they're multiplying it. You start getting around people with these conversations and having these kinds of conversations, it's going to go a lot further for you. But honestly, I would just say humbling yourself and getting educated. Humbling yourself, taking yourself back to those early med school days, getting humbled, right? That's probably going to translate for you a lot better once you get into the business side of things. When you get into real estate, you're a baby.
Mm-hmm.
You're a baby. Imagine you're representing yourself in court against another lawyer and you have no experience. They're just gonna do whatever they want with you, right? It's kind of the way it is in real estate. So you got to get around a lot of good people, that actually know what they're doing, if you want to effectively, multiply money.
Mm-hmm.
And so, it's really hard to ask a physician to say, hey, you're probably better off taking a part-time locum job than working full-time in medicine. And a lot of people and your listeners probably aren't going to agree with that. Well, it doesn't make financial sense. Well, it does make financial sense when you know how to multiply money.
Yep.
If you can work 3 days a week and the other 2 days a week you spend learning and looking at real estate deals or managing your real estate portfolio, all of a sudden it starts to make sense because that's something that's scalable,
Mm-hmm.
right? And so that's a part of our anesthesia MSO that we've created, is that we want to be overstaffed so people can elect to work part-time so then they can build real estate with us and work on building out a real estate portfolio with us.
That's great. Yeah. Where are you doing the anesthesia MSO? What
It's in
locations?
Oregon, Washington, and Northern California right now.
Okay. That's
Specifically
fantastic.
rural environments.
I like that. Yeah, I
Yeah.
think that there's obviously a ton of physicians out there who are okay just being employed and just kind of doing what the system tells you to do.
Yeah.
Fight the insurance companies and take a pay cut every year, and they're just going to keep going
Yeah.
along with it. But I think there's a big subset of physicians right now who are fighting against that, fighting against the norm, if you will. To your
Yeah.
point, trying to educate themselves and figure out what avenue do I go. And so I think that's great advice.
Yeah. Yeah, and just I can't say it enough. You got to learn the game that we're playing. We're playing the financial game at the end of the day
Mm-hmm.
when it comes to investing. And the financial system is built on raising a bunch of credit, increasing your purchasing power to get the maximum amount of your time, you
I
know?
love it.
And I mean, I'm jealous in some ways of people that can just go to jobs, check in, check out, go home, sleep at night, well rested, 2 weeks of vacation a year or 6 weeks vacation a year. I don't know. I get jealous of them sometimes, you know?
Yeah. Some people call
So
that the rat race, right?
yeah, for sure. For sure,
Yeah.
for sure.
You get jealous because you're like, your brain doesn't work that way, right? That growth mindset of,
Yeah.
I got to be doing more, which I think most people probably have.
Oh
Um,
yeah.
but do they get themselves in situations where they feel stuck, or
Hmm.
maybe they overspent on certain things early on? But I mean, to your point, there's ways out. There's
Yeah.
education can get you out of a lot of things, right? When you understand
Yeah.
and figure out where you can get more access to capital. I love it.
Oh
Nope, I
yeah,
think you're doing
100%.
yeah, you're doing great
So
things, man, by educating. Go ahead.
I just set up a consulting program with a third-year resident, anesthesia resident, right? That I'm hoping to recruit to Northern California.
Mhm.
And I told him, I said, dude, do not sign one of these zero down physician loans for a house. Do not go out and buy a new car right away,
Yep.
right? Because the minute that you sign one of those zero down physician loans, I mean, you're effectively underwater in a lot of these properties.
Mhm.
So you buy a 600 to $1 million house with a zero down physician loan. What happens if you don't like that area? What happens if the contract doesn't actually go through?
Mhm.
You just set yourself up for a $200,000 loss within your first year out of residency. And so it's conversations and communications like that that even yourself can have with a lot of residents that can benefit people.
Yep.
And so my Instagram online consulting business portion, all it is just exposing people to building business credit and getting them on the game board. From that, if people want to partner in real estate and do deals, I'm more than happy to do that. But it all has to do with whether you want to be an active person or whether you want to be more passive. It all has to do with where you're at in your emotional intelligence. I would much probably prefer a lot of people invest in syndications with you, Kyle, than do active deals with me. And that's me just being honest. Because active deals with me, we're on the phone every 2 weeks.
Mhm.
We're actively negotiating with contractors and timelines and lenders, right? And some people don't have that appetite. Some
Right.
people just don't.
Yeah, I love it. So people listening to this, where can they find you if they are interested in learning more about what you're doing?
Yeah, so if you go to Instagram at Benjamin Maciel _MD, either myself or my VAs will respond to you. Now, for some reason, if you don't follow me first and then you send me a message, it goes into like the spam inbox oftentimes. So if possible, follow me first and then send me a message and we'll get connected on a consulting call. We'll set up your whole business credit profile and we'll start investing in some real estate together. But that's probably the best way to get in touch with me. Now, one person somehow or another, like this guy found out my number online. Don't call me because 9 times out of 10, it's going to be like a spam or I'll send it to voicemail, right? And so Instagram at Benjamin Maciel _MD, that's by far the best way to get a hold of me.
That's great. Now, this is a great episode, man. We appreciate you. You're doing something that not a lot of people are talking about. So I love it. And it just so happens I had a guy on previously talking about business credit. And I think it's fascinating. I think that a lot more people need to learn about it. And again, it's really what, the wealthy think about doing, right? It's what they are doing.
Yeah.
So we appreciate you coming on here. It's a pleasure to get to know you. And we'll put this out here soon.
Wait, we should do in about 6 months, we should do an episode on SBA funding.
Yeah.
And by then I should have some updates on a few projects and deals with you guys. Talk about SBA funding.
We could absolutely do that. Let's plan it. All right, brother. We appreciate you. This is my time. I'm on the rise. Can't hold me down. I'm too fly. This is my time. Thanks for listening to the Doctors Investor Club podcast. I hope today's conversation inspired you to think bigger, dream bolder, and take the next step toward financial freedom. If you're a doctor or dentist and you're ready to join our community, head over to doctorsinvestorclub.com. There you'll find our free mobile app and private forum, built exclusively for physicians and dentists, featuring AI tools, curated investor resources, and live event access. And if you're at the stage where you want to see real estate opportunities we personally invest in, you can visit investwithdrkyle.com. There's no pressure, just transparency, education, and access when you're ready. Subscribe to the show, share it with a colleague, and remember, you're not just building wealth, you're building a legacy.